Hello friends, this is Professor Amarjeet Kaur, Professor of Accounting at Department of Management, Gurugram University, Gurugram. It's my privilege that I am a student of accounting and I believe in sharing the knowledge and that's how I am here with you this day to talk about financial instruments. So friends, we started with financial management as a subject a couple of weeks ago. We have covered basics of financial management and we reached to talk about financial markets, financial institutions, financial instruments as part of financial system. So within financial management, we actually started with financial system, and within financial system we have financial markets, financial services, instruments, regulatories, etc., etc. So today I am going to talk about one of the important pillar of financial system, which is financial instruments. So that is the agenda for today. So financial instruments, as the names suggest, instrument. Instrument doesn't mean the instrument for singing, etc., etc. Instruments means those documents which are used or which work as a vehicle to move the funds from the surplus sector to the short-term sector, because financial system is primarily there to move the surplus fund from one sector to the sector which is having shortage of funds. That's what primarily the financial system is doing, and to ensure that that movement happens smoothly, we have financial markets, we have financial institutions like banks and insurance companies, etc., etc., and we have financial instruments as well. The check signed by you, which is issued for a particular bank to pay, is a financial example of financial instrument. We generally go and get pay order or a draft ready for paying somebody is also example of financial instrument. Cash currency is also an example of financial instrument which helps us to move, exchange. So basically, the sector which is having shortage of funds, it could be a business, it could be government, it could be individuals, it could be anybody for that matter, and the one which is having surplus. So these instruments helps exchange surplus fund, the funds per se, right? That helps us movement of funds, right? That become enabler, they become instrument, they become enabler, they become vehicle to carry that surplus to the shortest sector. Now, financial instruments, they provide a smooth flow of transfer of capital among the investor across the globe. It's not only limited to a city or a country or or within the company, but across the globe, right? So these may be called as an assets in cash, contractual right, to deliver or receive cash, or simply an evidence of ownership in some equity. They all can be taken as financial instrument. So how do we define financial instruments? So financial instruments, they refer to monetary contracts between parties. They can be created, they can be traded, modified and settled. Thus, it is a contract that gives rise to financial assets of any one entity and a financial liability or equity instrument of the other entity. So, you must have got a clarification by looking at this slide that these financial instruments, they are financial or monetary contracts between whom? Between the two parties, of course. In a government of India and the person who owns the rupees is a contract between the two party, right? So they can be, these instruments can be created, they can be traded, they can be exchanged, they can be modified. There is a provision to modify any of the instrument, and they can be settled. Finally, they can be settled for demand of equivalent amount of benefit or money, right? So this contracts gives rise to financial asset of one entity and financial liability or the equity instrument of the other. Because if I possess, I issue a bank draft or I issue a check, so that is, and check is given to Y person. So I am X issuing a check, giving it to Y. So Y owns this check now when he received. So Y is, it becomes asset in his books, right, in his hand, and it becomes liability for me because I issued, so, right. So this is how it works. So it is one, for one entity it is an asset, is a financial asset, and for the other party it is a financial liability, obligation to pay. And this instrument, they refer to a real or a virtual document. It does not mean the document needed to be real all the time. It need not to be hard document in hand. It just represent a legal agreement that involves the kind of monetary value. The important thing is it has some monetary value. Nowadays we have virtual places which are being sold, you know. So that document gives you an ownership of a particular place, right. So that document which gives you a right or equivalent to certain monetary value is a financial instrument. So international accounting standards, which have been there, they define financial instruments as any contract that gives rise to a financial asset of one entity and financial liability or equity instrument of another entity, very much like as I explained. So two entities are involved. One who is issuing it to other to pay is liable to pay. So it's become the liability. The one who receives it, who owns it, finally it becomes the asset for that person or individual or that entity. It need not to be person. When I say entity, I am referring to both the natural person, natural entity like me, you, or an artificial person like a company, a partnership firm or a firm, etc., or an organization, NGO, anything, right. So it includes both artificial as well as the natural one, but and it need not to be a physical document, it need not to be real document which can be touched, seen. It could be simply a legal right given through a virtual document. Okay, so basis on the discussion we just had, it leads us to define certain characteristics of financial instruments, what they are. So financial instruments, they possess certain characteristics or key features in them. These are number 1 capital flow, number 2 liquidity, number 3 risk management, number 4 accounting, number 5 corporate bonds or debentures. So what does it mean, the capital flow? First of all, the major characteristics or key feature of financial instrument, that they are instrumental, they are vehicles, they are carriers of flow of funds. You take any example, the check is something you can assume very easily. Draft is another thing which you can assume easily. FD, for example, you go and open up an FD with a bank and you get an instrument, that piece of paper which says this is the your fixed deposit instrument, which is telling you that you have deposited X amount with XY bank. So that is ensuring capital flow, all these documents. Think further, even a debt instrument, if you buy a debenture of a company, right, so what is that? That is also a financial instrument, because it's helping movement of funds from your pocket, because you had savings and you wanted to invest somewhere, that is why you bought debentures, right. So your saving means surplus, you had surplus, you invested in the debentures, and the company which took the loan from you in the form of debentures, they issued you an instrument known as debenture or bond, giving you legal right that you are owner of that much amount as a loan extended to the company. So I took the example of FD as well. So fixed deposit, there were times my father will go to bank deposit and he will get a physical FD instrument. But nowadays we people are not getting those instruments in actual, we are getting virtual. We are getting, we are opening up an FD or saving account or any account online, and even the FD is, the instrument may not be in your hand, it is just a virtual proof that you have deposited. So that's what it characterizes, that number 1, these instruments have the major characteristics of ensuring flow of capital from surplus to the shortage, number one, and they need not to be real, they can be in digital format as well. Second thing is, the another feature is they help us maintain liquidity. All marketable assets which we call financial instrument or financial assets, for example treasury bill, commercial paper, they are handy, they can be sold immediately for money, so they ensure liquidity. Cash in itself is an example. Having cash in your pocket is that you feel so that you have a very good liquidity with you. So they are these instruments, financial instruments, they help us ensure liquidity as well. For example, if you have gold in your locker, that is not as liquid, they can be marketed as the gold bond. Gold bond is an example of instrument, whereas gold in itself is not an instrument, right. So, gold bond ensures liquidity, you can sell it off, you can trade it over the counter or on the, if they are registered on the exchange, any exchange, stock exchange, and then you can get money for that, right. You have shares of a company, you can quickly sell it off and get money for that. So, these shares are also example of financial instrument, debentures, bonds, shares, FDs, RDs, saving account, checks, drafts and what not. That is how the whole financial system is working. And if we have banks as financial institution or insurance company as a financial institution, so these financial institutions have certain system of working, right, ensuring receiving money and then giving it to further people who need it. They are bridging the gap between the needy and the provider. Okay, so and this liquidity management is possible because financial instruments are there, and this is how this has the second major feature in the financial instrument. The third is in risk management. How come financial instrument possess the characteristic or feature of helping us risk management? Risk is what? Risk is possibility of occurrence of anything than what is expected. That is how the most layman's language the risk is defined as, right, variation or deviation from of the real outcome from the expected outcome is risk, right. How does financial instrument help us in managing risk? Let's say we have SIPs, mutual funds. So, that instrument which gives you right, that you have an investment in systematic investment plan, you are basically spreading the risk over so many people. Even the insurance, even for that matter, is helping us. That insurance policy is basically is an instrument for managing risk, right. So, you do not have enough knowledge to invest in mutual fund, but you are buying a certain part of any fund, debt fund, equity fund through SIP, and you are managing your risk because someone else is actually investing on your behalf, who is technologically stronger, who is financially more literate than you or me, right. So, these instruments, they work as source or rather a technique for risk management. Then another characteristics in financial instruments are accounting. So, they help us in accounting the assets and liability of anybody. One entity who owns financial instrument, for in their books they are assets. The another entity who has to pay against that demand, against that promise, is liable to pay. So, it helps us, financial instruments help us calculating easily the assets and liability of any entity for that matter. Then corporate bonds and debentures also become part of financial instrument. It is not only the ownership right, it is not only the debentures and bonds are also part of financial instruments, because they help us move funds from one place to another, from surplus to shortage. So these are the characteristics of financial instrument. They need not to be all the time in claimant, in equity form, in cash form, in ownership form. It could be in debt form as well. Now, the categories of financial instrument, that's what I would like to talk about. There are primarily three categories, broad categories of financial instruments. Number one, we call them as cash instruments or primary instruments. Here we have debt and equity. Then the second number is they are known as secondary or derivative instruments, and number three is foreign exchange instruments. I will be addressing the first one, cash instrument, in this session, which is comprising two parts, debt and equity instruments, and derivatives and foreign exchange instrument will be covered in the forthcoming sessions so soon. So, first one is primary, which is cash instrument, debt and equity. So, cash instruments are financial instruments with values directly influenced by the condition of the market. That is how generally we call them as cash instrument. It means the instruments, the value of the instrument, value of that particular instrument we understand, right? It is a legal right, so promise. So, if the instruments linked to the market value, market conditions, so if the financial instrument with values directly influenced by the condition of market is known as cash instrument. So, it could be securities and deposit, it could be loans format, it could be in security format, which is, or a deposit format or loan format. So, financial instrument primarily, which we call as cash instrument, or we also call it as primary instruments. The stock and bonds are example of such primary instruments. Very simple example, stock and bond. So, we know that stocks and bonds both are affected by the market price, debentures and stock. This is the cash instrument. Then cash instrument may also be deposits and loans agreed upon by borrowers and lenders. So, if I take loan from a bank which is linked to the market, which does not have the fixed rate, but it is a flexi rate, it becomes cash instrument. Checks is an example of cash instrument because they transit payment from one bank account to another bank account. It is also an example of cash instrument. So, these are few examples, be it stock, bond, checks, etc., etc. These are example of cash instrument, or we call it as primary instrument. So, as I said, in cash instrument we have debt and we have equity. Debt means does not give you the ownership right, but gives you the promise to pay back as a deposit right. So, we have bank deposits, be it saving, recurring deposit, fixed deposit. Then we have loans, project loans, OD, etc. We have government bonds, treasury bills and corporate bonds, debentures. These are the debt segment of cash instrument. Let me explain to these 5 points in few minutes. So, first one is bank deposit, the most commonly used example of cash instrument under debt category. So, if you go and give create an FD or recurring deposit where you pay every month equal amount or every week equal amount or every quarterly equal amount, or in a saving account, what is happening here? You are giving deposits to a bank, right? It becomes for bank, that is a liability in the so your account which you have opened in a bank, your FD in a bank's balance sheet is a liability, and in your books it is an asset, right? That is how the instruments are defined. It gives ownership, it gives it is liability for one, it is asset for another entity. So, you are an entity who has deposited. So, you have an asset in your books, and in bank is the one who has taken the money from you. So, in the bank's book it is a liability to pay back. So, that is first thing. Loans, companies take project loan, businesses take overdraft facility from banks. You can take loan from individual for individual purpose, be it car loan. It's a document, it's an instrument. So, that document, that policy, where you have taken the loan, which gives you all the details of the loan, the time period to pay back, or the interest rates, etc., etc., that instrument, that document is a financial instrument, right. So, it is in the form of loans. So, that is a debt instrument under cash category, cash instruments. Then government bonds, government may issue, any government of state or a central government may issue bonds for its needs of funds, promise you to pay back. So, we have gold bonds, we have normal government bonds in with different 90 days bond, 120 days bonds, etc., with many different names, right, infrastructure bonds, etc., etc. They all are examples of cash instruments which is under the category debt, not, that is not an ownership right, that is a debt right, that gives you promise to pay back, of course, but does not give you any kind of ownership in the entity who has taken the money from you. Treasury bills, TBs are again issued by the government, 90 days, 30 days, they are for short term needs of a government. Both state government and central government, they both issue treasury bills, TBs, and that is also a debt instrument, example of cash instrument. Then we have corporate bonds or debentures, companies issuing debentures. Companies issuing debentures and bonds is of course an example of debt instrument, cash instrument, and it works as a vehicle to move funds from the surplus to the shortage sector. So, these are the examples of cash instrument and where the debt category has been discussed. Same way we have equity category which is cash instrument falling under the equity. So, we have 5 of them: common stock, preferred stock, mutual fund, exchange traded funds, ETFs, and then certificates of deposit, CDs. So, let me explain them before we wind up. So, common stock is basically the normal equity, normal share. So, common stock, as the name suggests, the stock which is the most which is the common one, which gives the ownership right. Share, if you buy a share of X company, you are owner to the extent of the value of that share. If the share is, for example, one share as of now is for 2000 and you have 10 of them, means you are owner equivalent to the 20,000's value of the assets of that company. Make sense to you? So, common stock is the instrument, the company may there were times when we have seen the physical shares. Nowadays shares are just it's an entry, they are just being created virtually. Company people who invest, or the insurance company or banks who invest in the share capital of a company, individuals, institutions, everyone can buy shares, right. So, they get a virtual right, virtual ownership of to that extent. So, common stock is one thing, preferred stocks, preferential shares in other way, or preferential shares have preferential right over the assets of the company, they have preferential right at the time of liquidation, they are paid back before anything is paid to common stock, they have preferential right on dividend as well. Common stock does not give any guarantee of the dividend payment, have no assurance. Preference share have accumulation possibility, that the dividend if not paid gets accumulated for certain period, etc., etc. So, they both are example of ownership, equity, right. So, cash instrument that we discussed first, and now we are discussing equity. The third one is mutual fund. They are also cash instrument. If you have mutual funds in your hand, you may invest through any agent or directly, whichever way, that is also an ownership right, because mutual funds that to that extent you have that ownership. Then over the exchange or exchange traded funds are ETFs. So, those funds where which are listed, which can be traded over the exchange, and you have invested there, that is also an example of equity investment, and the instrument which is given to you, the right which is given to you, it indicates that is an cash instrument. You can actually sell it off easily and exchange for cash. The last is certificates of deposit, CDs. CDs are also kind of loan, kind of ownership right to certain extent. They are issued by corporates. All the corporates not allowed by SEBI or otherwise in worldwide. There are certain regulations on that. only those commercial houses or businesses can issue CDs which has very high credentials, high ratings, but nevertheless they also CDs, if you possess a CD, this also indicates that you have this much investment. So these are the example of cash instrument under equity. So I hope friends you were able to understand what are cash instruments, how or what all features or characteristics they possess, and how cash instrument under the first category, primary category or cash instrument help us move funds from surplus to shortage sector, and we have discussed couple of examples under the first category. Remaining two parts, derivative instruments and foreign exchange instruments, shall be discussed in the part 2 soon. Thank you very much.